Hello and welcome back to the ROI Channel, a channel that's obsessed with the art and science of return on investment in the broader umbrella theme of living life on your terms as a maverick, as it sometimes means going against the grain. Bit of a different look today, guys. I'm going to be talking about my investment philosophy, tools that I use, and how a lot of it has been inspired. And we will get into it. Nothing I say is advice. So today, I'm going to give you a resource. I suggest everyone read the almost 24-year-old article that was written by this guy here, Dr. Michael Burry, famous for his role in the Big Short scenario. The character is played by Christian Bale in the movie The Big Short, which I'm sure we all know and love. Cyan Capital was his first managed fund, and he was seeded by Joel Greenblatt. There's a very, very interesting history behind it all. I suggest you read The Greatest Trade Ever, which gives a lot more detail, a lot more factual coverage of the events that took place around 2006 through to 2008-9, and how two gentlemen in particular, Michael Burry, as mentioned today, but also a man named John Paulson from the hedge fund Paulson & Co., who made $4.5 billion in one day. So I highly recommend it. This is a PDF that you can get online. Literally just Google Michael Burry case study strategy PDF, and I highly recommend you go through it. There's a one-pager on his investment philosophy. That's it. And the rest is some commentary as to investments that he made way back when. Fascinating reading. And I've got a couple of excerpts that I want to share with you guys. The reason being, I'm trying to show where my thinking lies and how I've adapted Dr. Burry's approach to a style that suits me. And that's what you will have to do as an individual, and in terms of making your own investment decisions. And then, of course, seeking more expertise if you have a larger amount of capital for fund management. But it's always important that you understand what your philosophy is and what your temperament is like, and finding someone who not only has the know-how to generate great results, but is in line with your temperament and your belief system, because you're going to have to adapt to their time frame. I think that's a very underestimated point. So let's get into it, and we'll see where we end up today. And I think it's going to be one of those things that's very valuable. It's not an analysis as such, but I think you're going to build a lot of key skill sets. The excerpts from the letter that really stand out to me, and that would be mirrored a lot in my comments on my investment approach to those of you who follow the portfolio on eToro, would be this. I'm going to read word for word. I care little about the level of the general market and put few restrictions on potential investments. I agree with that to a certain level. Remember, this was 24 years ago, before we had one round of quantitative easing by the time Dr. Burry was really getting into this. And I think then things are a little different. The general market has changed with the inflow of ETFs becoming the marginal buyers. So overall, in terms of evaluation, I don't care so much about whether I think we're coming into good or bad economic times. Investments, there's always a bull market somewhere, as the saying goes. But I do care a little bit about if I think stocks are generally relatively expensive, unless I can find pockets of value. And that's why I'm so focused in the energy space at the moment, because I believe that's where the value is. They can be large cap, small cap, mid cap, micro cap, tech or non-tech. It doesn't matter. I agree with that 100%. I don't care necessarily what the size of the company is. I don't care necessarily where the company is situated, unless there are some segmental or macro factors that I think might be hitting a particular sector. Then I might be a little bit more cautious, perhaps, in taking a position in a consumer discretionary company. Let's say if I believe that we're heading into harder economic times. Or I might favor, obviously, the energy case is well known. I think that there are a lot of tailwinds for the energy sector. And so that does lead me to focus a little bit more towards that particular segment. But I care very little for large, small, or mid cap. To me personally, it doesn't matter. Small caps I have a favor for at the moment, because I believe not only is that where most of the growth can come, that is also where they've been steeply sold off since COVID. I find out of favor industries a particularly fertile ground for best of breed shares at steep discounts. If you've been watching this channel, you will have seen not just through my videos, but the interviews that I've done with the likes of Rick Rule, with Justin Hune, with Josh Young, the commodities guys. This, I think, would ring true for almost all of us. And it makes a lot of sense. It makes common sense. Where will the best discounts be? Where nobody else wants to look. And I come back to one of the first comments I ever received on YouTube, which was a guy saying, I love your videos, really great. You just focus on companies I'm not interested in. And that was absolutely music to my ears as an investor, because of course that's where the bargains are. If the bargains are never in the popular stuff. How do I determine the discount? So a little bit more technical. I've usually focused on free cash flow and enterprise value. And that, if you've been watching, that's been a theme on the channel since the start. I will screen through large numbers of companies by looking at the EV to EBITDA ratio, though the ratio I'm willing to accept tends to vary with the industry and its position in the economic cycle. 100%. I also would add, and this is a key point here in terms of what I've learned about thinking about investments. Not everyone talks about processes and strategies as if there was a formula, and there are factors that are formulaic in the process. But I like one of the first things Josh Young ever told me, which was he thinks about it as a mosaic. It's not so much a cookie cutter recipe, step 1, step 2, step 3, but taking different bits and pieces from different areas and putting them all together in a kind of symphony, I guess, is perhaps a better way to look at it. So EV to EBITDA, EV to free cash flow, you guys know that's something I focus heavily on. In addition to which, something that I learned from a very successful investor and a colleague of Warren Buffett's at one stage, or a fellow alumnus of Warren Buffett, Walter Schloss, who focused heavily on discount to asset value. And so I take this approach of discount to free cash flow, and I try and match it up with discount to asset values as best I can to get the best of both worlds. And then I add on top of that, if I can get indicators of good management practices, so return on invested capital, return on equity, although be careful, and Dr. Burry talks about that. Return on equity can be misleading because you can load up a company with debt, make the earnings look really good in terms of return on equity, but you start to play a dangerous game in terms of putting the balance sheet in danger. So my guidelines, I do have a lot of thoughts that are very similar to Dr. Burry's and very similar temperaments. I'm not sure if it's we both came from a medical background, and maybe that's an explanation. I really couldn't say. Burry talks about usually holding 12 to 18 plays in terms of a portfolio, so 12 to 18 stocks. I currently in the eToro portfolio hold 18, and that number could be as low as 12 easily. I have no problem with that. My personal longer term wealth portfolio is just over that 18 mark at the moment. My income portfolio, for which I use options, has 5 to 6 different assets. And I think for me, my temperament allows me to tolerate a lot of volatility. I do a lot of due diligence, and I build some conviction to a large degree in the companies that I hold or the assets that I hold. It doesn't mean I always get it right, but I have just found I started initially with more of a hedge fund type approach of having this. I would say it's almost a fantasy for most of us, except for maybe Bridgewater, to have non-correlated sources of alpha, and I just think that's very, very difficult for anyone to pull off repeatedly and successfully over time. Instead, I've found that having more of a concentrated portfolio, accepting volatility, and focusing more on the art of executing the trades has made a really big difference to my investment in public companies. My time horizon, I would say, is a slightly longer than Dr. Burry's. Dr. Burry talks about he's looking for that 30, 40, 50% pop within sort of 12 to 18 months. And if he gets that, he's quite happy to sell and rotate that capital into the next theme. He cares less around the taxation perspective, which you can read in that PDF. I think that's very interesting. I think someone with the skill set and the experience that Dr. Burry has, he has access to a lot more information, a lot more ideas quicker than I will across the globe. I find it easier, or so far I've had more success, probably better to say, to have fewer ideas, really wait for those that are really, really juicy and offer tremendous upside, and being willing to simply wait a little bit longer. I have a track record now of seeing things ahead of the market, ahead of other people. And that's obviously an advantage only if you can hold out. So for me, I look at a hurdle rate of 20% IRR. So I'm looking essentially for an investment that I think can double at least within 3.5 years, ideally. And if you work that out on an internal rate of return, you're looking at around 20% IRR. And I think that for me is more simple than for me trying to work out something that might pop 20 or 30% within a 12-month time frame. So that's a new focus of mine over the past year and a half, and it seems to be working very well. So I'm obviously going to do that. Another thing that I would comment on, if you read the book The Art of Execution by Lee Freeman Shaw, he talks about the most successful investors in his studies were the ones that really let their winners ride. So they gained multi-bagger status and didn't sell until they really started to run away, and they sold in tranches. That allows you to make up for a lot of mistakes in portfolio. And I would have to say that I've found that approach a little better, which is why my time horizon is slightly longer. Unless there's like a ridiculous pop within a short space of time, I generally just let things run. And if they drop back in price, okay, no problem. And that valuation is my North Star. I'm looking to buy it at a discount, sell it ideally at a premium to the valuation. A lot of value guys sell just at the valuation for many reasons, most of which are sentiment and psychologically driven. You can almost always expect an overshoot of that fair value, and that's what I'm trying to be disciplined in terms of exiting with such a method that allows me to capture some of that extra upside. So taking some of the position away at fair value, leaving it a bit on the table, taking a little bit more, and selling into some of that irrational exuberance. One thing for me, just a personal lesson on valuation, just focus on low multiples, steep discounts, low multiples, buy cheap stuff. It sounds so simple. It is simple, but it's easy to get seduced into a narrative of, oh, well, this thing, GoPro was a good example. I bought GoPro. It had some good valuation metrics, or so I thought, and I just put way too high of a multiple on it because it was easy to justify it as a software company now. And so you put a software multiple on it. Other people I see look at the common narrative right now of justifying some of these insane multiples, mainly in the tech space, on growth, the narrative of growth. And growth is in the future. Growth is not certain. Growth can change. It's a fool's errand, in my opinion, to really rely on growth as a method of your valuation. Sure, it can play a part, but it's just so much easier to buy something at a 3 times cash flow than it is to buy something at an 80 times cash flow and make money overall. Although if you've bought the Magnificent Seven, you've probably done okay. I think that's more a result rather than solid fundamental thinking. But hey, we'll see. Avoiding temptation to chase the high multiples with peer comparison and growth promises, as I mentioned. My best results in private investing, in public investing, have just been from buying cheap stuff, low price to cash flows and or asset value. That's how I define good value or cheap, with a caveat that management really does matter. So sometimes if you're using screeners, or if you've just got a purely quantitative approach, you can come unstuck by a company that appears for all the world as if it's really great value, and management are the reason why it's trading for such a cheap valuation. So some examples, obviously, Custom Maritime I've talked about before. Luckily, it's not going to make a difference to my net worth really at the end of the day, and it hasn't. But it was a good lesson. This looked objectively and quantitatively very cheap, so I bought some shares, and I was just amazed. The lesson stuck with me about how if a management team really screws you over, it really can override all the wonderful quantitative valuation that you can do. Similar deal at the moment I'm seeing with Nano Dimensions. The thing trades for less than its cash at bank almost, and they've been doing some deals, but management has just lost the confidence of the entire market, and I think some ordinary management is really hurting that stock. So that's the only caveat. Most of the time, you can't go wrong. Just make sure you got management aligned with your interests. The execution, this is the part that's made a big difference for me, and it's a part that doesn't get talked about enough. In fact, execution can make up for bad investment analysis. Possibly better to say bad investment analysis or good investment analysis cannot make up for bad execution of entering and exiting your stock plays, if we're talking about public stocks. So I really want to impress upon you the importance of executing your entry and your exit. This is something where I want to improve. And so my New Year's resolution is to really focus on this. Entering and exiting in tranches, that just means in slices. So if I've got 3% that I want to allocate for one given stock, I might start buying, just allocate 1% at a time, and then a little bit more, maybe a month later, or depending on how the stock behaves, buy a little bit more. If it drops a little bit more, away you go. Again, I recommend the book, The Art of Execution by Lee Freeman Shaw. I think it's a really, really underrated book. I will ignore this if I think an opportunity really warrants it. I think where we are in the offshore space warranted me going very heavily into Valaris, for instance. When I did, once I was happy with it, I said, pull the trigger. And I suppose the counter argument to this would be something Howard Marks says, where one of the tenets of Oaktree Capital Management is, if it's cheap today, we buy it today. And that's it. We don't care if next week, if it's cheaper, we say, okay, bad luck. Or if we have extra cash, maybe we buy more. And we sell when we think we can't justify it holding it anymore. And if the price keeps going up, so be it. So there are two ways to look at it. I have found that focusing on the execution has helped me a lot. And so I want to continue really refining that discipline in 2024. One tool, again, that Dr. Burry mentions in the PDF is using the RSI and using yearly high and low. So he talks about preferably buying his stocks once he's done the valuation and he likes it. If he can buy it in within sort of 10 to 15% of the 52-week lows, he always saw that as a good entry point. So I'm starting to take that on board also. RSI, I like to buy in sort of the low downtrend. When the RSI is in the 30s, that signals to me a very good time to put one of those tranches at play, let's say, in terms of entering. Sometimes the stock is chopping and going sideways. It's either expensive, not expensive. It's either got a lot of momentum in the RSI, but I still think it's good valuation from a fundamental value perspective. But I think that I might be able to get a better entry point in the future. This is where shorting puts is the best of both worlds for me. It helps me a lot. I can sell a put option on a stock, and it either drops to where I want, the market comes to me, or it doesn't. If it does, great, I get the stock at a discount. If it doesn't, no problem. I get paid handsomely on a annualized rate of return basis to sell the put option. I keep that money and I can continue to roll on my merry way. So a 2024 resolution, really to pay a little bit more attention to the art of execution. I'm happy with my approach now. I'm happy with sticking to my guns, doing what I do, come what may, because over time, it's a strategy that's been shown to work. Focusing a little bit more on the execution, tidying up the entry and the exit, using the RSI and the 200-day moving average, and then using that to inform me when to increase the weight of my buying tranches or selling tranches when buying, when it's within the 10% of 52-week lows, or when RSI is in the 30s. And let's take a look at one such example. So Valaris, we're here. We've got our 52-week low around about 55 and change, let's say. So within 10 to 15% of that, we're here. $60 is within 15% of that 52 weekly low. So check one. It's below the 200-day moving average. It's had this steep drop off on news of Saudi Arabia pulling back its production targets. I think this is overdone. The RSI has really bottomed out around the $32 mark. So we know, if you watch the channel, there's a free video on my take on Valaris, so you can see what I think the company is worth. And in terms of an entry point, this would signal that it's a wonderful entry point now, given the fact that momentum is really getting towards oversold. It's a long way below its 200-day moving average, and it is also within 10 to 15% of its 52 weekly low. So I hope you enjoy this video. I think it's one that probably won't catch a lot of attention. It's not flashy. It's not telling you, oh, here's what I think this stock is worth. But bloody hell, we get to learn from this guy for free, essentially, by reading the PDF and just doing a bit of thinking, just doing a bit of reading, doing a bit of writing, putting some things into practice. And so I hope that this helps you in your investment decision-making. And I also hope that it helps you understand my philosophy and my investment decision-making so that you can really understand where I'm coming from in doing these deep dives on the channel. If you're a subscriber to Substack, thank you very much. I appreciate it. And if you're a copier of the eToro portfolio, again, I appreciate that. And I hope that this gives you greater confidence in the strategy and the techniques used to generate the returns. So take care, guys. All the best. Do your own due diligence, and I shall see you in another video shortly.